Hello and welcome. You're watching an exclusive conversation with Ms. Aditi Nayar, Chief Economist, ICRA, on the Economic Survey 2021-22 that was tabled in the Parliament earlier today. Welcome, Aditi. Aditi, what are the key takeaways from the economic survey? Indian economy is expected to grow at the rate of 8 to 8.5% in FY23, and for FY22, the economic survey puts the growth at 9.2%. What do you have to say?
This is a very interesting time for the economic survey to be tabled. We are into 2 years of the pandemic, 3 waves of the pandemic, and a lot of uncertainty in terms of what lies ahead. And we believe that as far as the economic survey is concerned, it's presented a very pragmatic view in terms of the stock taking that it's done for macros, for Indian macros, and the outlook that it's provided for FY23 as well. So, our initial reaction was that we are looking at a slightly lower GDP growth in FY22 itself. This is partly taking into account the impact of the third wave, the slight disruption caused by the third wave in the ongoing quarter. But also, we have a view that growth was not very high in Q3 itself. And now, we just got the revised estimates for FY21. And the pace of contraction indicated by those for FY21 is narrower than what we had earlier, based on the May 2021 estimates. And therefore, we're sort of reworking our calculations a little bit. It's impacting the FY22 growth as well, in terms of what it means now compared to the narrower contraction for FY21. And, the pace of expansion in FY22 now looks like it's going to be somewhere between 8.5% to 8.9%. The view we had was 8.9% before having seen the FY21 revised estimate. For FY23, we're a little more optimistic simply because our assumption for FY22 is on the lower side. And we do think that with a very sharp base effect for the first quarter, because of the impact of the second wave on the economy, FY23 growth is likely to be closer to 9% over FY22. Okay. And that's a little bit better than what the survey has projected today.
If we talk about the economic recovery that we have seen so far, is it durable, sustainable? What do the high frequency indicators point to?
Yeah, absolutely. We don't believe that the recovery that we've seen so far is either durable or sustainable. When we look at the high frequency indicators for Q3, there's a little bit of broad basing that we're seeing in the recovery. A couple of the sectors moved from a contraction over pre-COVID in Q2 to a growth over pre-COVID in Q3. But the lagging sectors, most of them continue to lag their pre-COVID performance even in Q3. So from that point of view, the broad basing that we saw in Q3 was only moderate. And as far as the movement of the high frequency indicators through the quarter, we had a lot of high growths being reported in October that completely fizzled out in November. Two reasons for that. One, of course, we had a lot of holidays related to the festive season. Although when we look at YOY growth, that impact really goes away because the festive season was in November last year also. But there were some indications that growth was slowing down across many of the high frequency indicators. Part of the reason for that was that we had very heavy rainfall in the south in that month, and that caused a supply chain disruption that our clients were telling us about as well. Things improved in December. For example, we've got the core sector data for December that just came out today. That's at 3.8% versus 3.4% in November. But it's much lower than the growth that we saw in October, which was more than 8% for the core industries. And this is a trend we've seen repeated across a whole host of the high frequency indicators, that there was an uptick in December compared to November, but the YOY growth was still lower than the level that we saw in the month of October. And for December, we are looking at an IIP growth that's going to be lower than 2%. So overall, it's not really been a very great quarter in terms of volume growth, despite the festive season. And value growth has been a little bit better because many companies did push through price increases during that quarter, and we have seen a lot of companies reporting better margin growth, better margins and better revenue growth than volume growth in the third quarter. And I suspect that's something that's going to play out in the GDP data as well. we are looking at a 6 to 6.5% GDP growth, GVA growth in Q3. So better than the IIP performance, but it's still going to be a base effect led moderation as compared to Q2.
What is the kind of revision that you would be seeing for FY23? Because the growth that you had projected initially was 7.6%.
For FY23, we are looking at a 9% GDP growth.
Okay. Yeah. Okay. So you'll be revising it higher?
No. As of now, we are holding on to our 9% GDP growth forecast for FY23. As I said, it's already a little bit higher than what the Eco survey has penciled in, because they're more optimistic on FY22. We're more optimistic on FY23. Part of the reason why we're more optimistic on FY23 is because we believe that economic agents of all hues, whether it's government, households, corporates, the health system, everybody is better prepared to handle another wave of the pandemic if it should manifest. Vaccination coverage has been very good in India. We've opened up to teenagers as well. That's also an important category in terms of creating better all-round protection for families who have kids that need to go to school, etc. That itself is going to add another layer of protection going forward. And in any case, I think there is no vaccine hesitancy in India. We are sort of well prepared. Households have learned, have adapted to the kind of uncertainty that they've seen in the last 2 years. In fact, we firmly believe that even in terms of confidence, the hit from the third wave is going to be much smaller than what we saw in the first two waves. So when the RBI data on the consumer confidence for the urban households comes out next month, if it indeed covers the period of the third wave, which I believe it will, we expect the impact to be quite muted because of the third wave.
I quote economic survey saying the government has the fiscal capacity to ramp up capital expenditure when required. So this all depends upon the tax buoyancy that we have seen in FY22 till now. What do you have to say about it? What does it indicate actually?
See, taxes have done very well in FY22, whether it's direct taxes and most indirect taxes as well. A few reasons for that. One, we believe very firmly that the K-shaped recovery has actually boosted tax revenue growth in India. There's been a shift from the informal to the formal sectors and from the small to the large. And therefore, the direct tax collections, particularly the corporate tax collections, have benefited a lot. On the indirect tax side, with GST and the anti-evasion focus, again, we've seen very healthy growth, both in terms of the GST e-way bills as well as in terms of the value of the taxes that are collected. Specifically, customs duty has done very well this year because there was a huge pent-up demand for gold. That's something that might disappear in FY23 if we normalize back to a normal level of gold demand. And excise collections have done very well in FY21 and 22 because of higher cesses. This is now set to contract in FY23, even if there is no further cut in the duties themselves, and there is a moderate improvement in the mobility. So a little bit of a mixed trend going forward for next year, but we do think that the gross tax revenues of Government of India will grow by about 9%, 9 to 9.5% in FY23, which is closer to our estimate of the real GDP growth for next year. Nominal GDP growth will be much higher because there is an element of inflation. We believe that CPI inflation will be very sticky. It's only going to come down from 5.5% to 5% at best. And the WPI inflation will come down very sharply from the double digits that we expect for FY22 to about 4% for FY23. I want to add that while we were in the throes of the Omicron fears, we were projecting WPI inflation at 2% for next year. And now that commodity prices have rebounded so quickly, we're looking at a WPI inflation of 4% for next year. And therefore, between 9% real GDP growth, 5% CPI at least, and 4% WPI, we're looking at the normal GDP growth being closer to 13.5%, which is a lot lower than what the expectation is for the current year.
Talking about the projections that are made in the economic survey, Aditi, the crude oil has been pegged at 70 to 75, and now we all know that crude is trading around $90 per barrel. So how do we take it?
One thing I can remember from all the economic surveys I've read in my career is that the one projection that always goes wrong is the crude oil projection. It is such a volatile commodity. We focus on it so much, to look at how to factor it into all of our projections for the next year. And crude oil, I mean, it's just so volatile. If you ask me if I have to make my projections for next year at this point in time, I will probably look at crude oil being between 75 and 85.
Okay.
So I'm taking a wider band, but a slightly higher band than what the economic survey has put in. I do believe that the fears, of course, have receded because of Omicron. We're all better prepared. But there is a large element of geopolitical tensions as well, which is pushing up the current prices. And if that were to settle, then we can look at prices at least being a little bit lower than where we are right now. Now, coming back to your earlier question on capex, I didn't get to answer that. In terms of the fiscal data that we've seen for December, there's actually a very big step up in Government of India's capital spending in that month. I would say about half of it is probably because of the equity infusion that had to happen into Air India before the divestment. But we certainly are holding on to our view that there will be no undershooting of the budgeted capex for FY22.
Okay.
For FY23, our view is that the amount of capital spending that can realistically be absorbed should be fully provided in the budget. And that is what can give the most durable growth impulse going forward. Our view is that it's better not to assume that there will be a pandemic next year, because if you do that, it takes away space for capex. Yeah. If there is another wave of COVID and it requires social spending, that can always be provided through a supplementary. It needed to be built into the budget estimates upfront. Because if you do that, then you take away space for capex, and capex is what can give the biggest push to growth, which is durable and sustainable. So we believe that at least 6 trillion should be put into the budget for capital spending. This will be a decent growth over FY22 if we remove the equity infusion component, the equity infusion into Air India that I was talking about.
In percentage terms?
I think it will be a double-digit growth if we take away the equity infusion component. See, what we've done is we have assumed that capex should at least be 50,000 crore per month. Okay. There have been only 5 instances, including December 2021, where capex has exceeded 50,000 crore since 2019.
Okay.
So this is something we believe, if we really want to push for capex, then at least 50,000 crore must be spent every month. And for the state governments, they're a very big contributor to capex. There's a couple of things. The biggest worry, of course, is that the original GST compensation period is coming to an end in another 5 months. And some states have a very high dependence on GST compensation as compared to their overall revenue receipts. Okay. Now, obviously, there's a fiscal adjustment that's ahead. On a cash flow basis, it will be a softer step down because there will be about 1.2 to 1.5 trillion of flows which the states will get on a cash flow basis in FY23, but it's going to be about half of what they got in the last 2 years. Okay. On the other hand, the tax devolution growth to the states in FY23 is going to be higher than Government of India's own tax growth. The reason for that is that the states don't get excise duty, the cesses on fuels. Yeah. That's not shared with the states. That's the component for Government of India that will contract in FY23, and the negative impact of that will not be shared with the states. So a little bit of an offset over there. We're also waiting to see if Government of India sticks to the 3.5% fiscal deficit to GDP ratio for the states, which the 15th Finance Commission had recommended, and whether they do a carve out for additional capex within that. So these are some of the moving parts which will help us to get a better sense tomorrow of how much capex we should expect the states to be able to undertake in FY23.
Aditi, do you expect budget going back to fiscal consolidation as we were talking, before the COVID crisis really happened, 3.5, and the government has targeted fiscal deficit taming down through next 4 to 5 years. So what is the kind of fiscal deficit target that you expect for FY23 FY23, and for FY22, what is expected?
So we have worked with the assumption that the LIC divestment flows, the LIC IPO flows will actually materialize in FY23, not in FY22. So this is the basic assumption that we made. And after that, we are expecting the FY22 revised estimates to report a fiscal deficit of 16.6 trillion, and the FY23 budget estimates to target a fiscal deficit of 15.2 trillion. So this is similar to the budget estimate for the fiscal deficit for the current year. We're not expecting a massive fiscal consolidation. We expect it to be gradual as the government sort of comes back to a more steady path. Secondly, we do expect that the buoyancy in tax revenues will end up being, targeted toward higher capex, as I was talking about earlier, and that will be prioritized over a larger fiscal consolidation because that's more durable in terms of the growth impulse that it will provide. So we're looking at a modest fiscal consolidation when we look at the percentage of GDP, and we do expect a sort of extended glide path back to the kind of 3.5%, fiscal deficit that we used to try to target earlier. We don't expect to get there in a hurry.
Mm-hmm. Talking about consumption, Aditi, public consumption has been good, government consumption has been good, but private consumption is still lagging behind, though it has seen some kind of an improvement. So on the consumption front, how do you see things playing out?
See, on the consumption side, again, it's a little bit of a K-shape, right? The households that are more affected by loss of income in the contact-intensive sectors or in the informal or the less formal sectors, those households would still be struggling in terms of getting back to a pre-pandemic level of consumption, whereas the households in the formal sectors or the ones which are not affected so much in terms of dependence on income from the contact-intensive sectors, their things would have roughly bounced back. After the second wave, things would have bounced back quite a bit. So it's a little bit of a mixed bag, and I suspect at a disaggregated level this may continue. But I do think that people would have contingency plans in place now, and future waves are probably not going to be as disruptive as what we've seen so far. And this is part of the confidence that we have, in our 9% GDP estimate for FY23.
Mm-hmm. Aditi, how big is inflation a concern?
It absolutely is. Inflation is clearly not transitory. We've got very, very quick rebound in commodity prices that we've seen since mid-December. And inflation is going to remain a concern. The economic survey talked about two things very clearly. One, the divergence between the CPI and the WPI and the reasons for that. And secondly, it talked about how imported inflation is a worry going forward, and we need to be wary of that. And I completely agree. When we look at various sectors, the price increases that were taken in Q3, they've certainly helped to support margins. But the rebound in commodity prices that has taken place subsequently does lead us to believe that there's one more round of price hikes that many companies may undertake. And this is part of as soon as demand sort of stabilizes. And this is, part of what's leading us to believe that the CPI inflation will correct very modestly at best in FY23. So far, our monetary policy committee has been able to prioritize growth because the CPI inflation target that they have is both very high and pretty wide. I should say wide, and the upper threshold is pretty high at 2 to 6%. We are sort of skirting that 5 to 6% range, and at some point, once there is more of conviction that there is a durable growth that is set in, the MPC will have to switch gears back to inflation management being the primary objective. And with the Fed clearly laying the groundwork for several rate hikes this year and interest rates going up globally, we think it's only a matter of time before policy normalization commences in India. As of now, I would say we're probably going to get a stance change to neutral in April, along with the reverse repo rate hike. And we're probably going to get two successive repo hikes after that of 25 basis points each. So the June policy and the August policy, this is sort of the baseline that we're expecting right now.
And if that happens, Aditi, what happens to the growth? Do you see that impacting growth?
So I certainly, in a sense, the price hikes themselves are going to put a lid on how much demand can go up, right? So that we are already sort of building in into our estimates. We're not looking at a broad-based capacity expansion setting in before the end of this calendar year. Uh, After the third wave, I would say that capacity utilization should be between 70 to 72% in the ongoing quarter. So a mild downtick as compared to our earlier estimate of 72%. And unless it crosses 75%, we really just don't see a very broad-based capacity expansion being undertaken. On the export side as well, we're a little circumspect. Yes, value growth has been very high. Yes, $400 billion will certainly be crossed this year in terms of merchandise exports. But the port cargo traffic data, which is the volume data, is quite tepid. And we think that commodity prices are playing a very large, disproportionately large role in pushing up the value of exports. So that is also something to sort of keep in mind in terms of looking at capacity utilization and expansion going forward. In the meantime, PLI sector, cement, steel, these are certainly sectors where capacity announcements are happening and will continue to happen. But it's not going to be very broad based until possibly this time next year.
Talking about the banking and financial sector, it has done very well as far as the gross NPAs and net NPAs are concerned. They are coming down. How buoyant do you see this sector, really remaining in times to come? Because credit offtakes is really a concern for them.
So, two things. Like if we look at even the revised data that we got, the GDP data that we got today for FY21, financial real estate and professional services and agriculture are the only two subsectors that have escaped a contraction in FY21. The sector has certainly been resilient. And in terms of credit growth going ahead, working capital demand is something that we believe will come up. Wherever capacities are being added, there will be demand for credit from those sectors, and it is broad based over a period of time. So, in terms of credit demand, we expect the drivers to be a little more broad based than what they've been recently. And a lot of the deleveraging that has had to happen has happened. So that overhang really is not going to be there.
Mm-hmm. Talking about disinvestment, Aditi, this year has been terrible as of now, but now towards the end of the quarter, we are seeing some kind of an, pickup in disinvestment happening with, some announcement for Air India, and now there is one more steel deal that might happen. So how does government really work with the targets for disinvestment and really achieve them?
Look, this is always tough. I mean, disinvestment is something that we have a roadmap, but timing is always going to be difficult to, capture at the time of the budget estimates. Last year, I mean, to be fair, when we prepared the FY22 budget estimates, we didn't expect the second wave, let alone the third. And such disruption is obviously going to be difficult in terms of, globally, the kind of scenario changes that we've seen, as well as, suddenly the impact of the Fed outlook now being a lot more hawkish than what we would have imagined earlier as well. All of these things do play a role in really looking at maximizing value through timing of divestment flows. But I would say that the positive thing is that the LIC transaction seems to be at a very advanced stage. Although we've assumed that it won't happen in FY22, we're only looking at a small spillover into FY23. And even if there is another wave of COVID-19, we don't expect this IPO to be stopped. We believe it will go through next year, and it will get a lot of capital receipts for Government of India, which can then be channelized into capital spending.
Mm-hmm. What is your view on the FDI inflows? I think till November, we have an FDI inflow of around 42.8 billion US dollars. There has been a little slowdown. What are your expectations?
See, the FDI flows, it really is a matter of some of the very big ticket announcements coming through. But other than that, we have seen a lot of smaller deals in the PEVC space, and that is something that has sustained FDI flows over the last few months, and that's something that we expect may continue going forward as well.
So what are your expectations from the budget tomorrow, Aditi? The three sectors that you'll be really focusing on.
Well, I think, the very first thing I look at is what is the budgetary allocation for capital expenditure on Government of India's own books. Secondly, what is the kind of indication on the extra budgetary capital spending through, the other NHAI, etc. Third thing I'll be looking for is what is the fiscal deficit target for Government of India, what is the borrowing limit for the states, and whether there's a subcomponent for capex within that. After that, I'll be looking at, what is the revenue growth assumption, the GDP growth assumption, how realistic do they seem to be, and whether there's, any other major, the national monetization pipeline, for example. Is there a major inflow that the government expects from that? Because that would certainly boost the fiscal consolidation process if there is to be confidence that flows from that source will start soon. And then, within expenditure, we'll be looking at which sectors get the biggest jumps in allocation, both in terms of capex as well as the social sector spending. What has been assumed for subsidies and for NREGA. Our assumption for both food subsidy and NREGA is, assume it's going to be a normal year, allocate for a normal year instead of allocating for a pandemic situation. But even on fertilizer subsidy, the input costs have been so high this year. We've seen large increases in fertilizer subsidy being required through the year, through the supplementaries. So, what is the kind of allocation that the government builds in for next year? That's something we'll be looking at as well. Health, education, agriculture, rural development, these are always important sectors, particularly for the feel-good factor coming out of the budget.
So will the bend of the budget be more towards growth orientation rather than, containing inflation and containing fiscal deficit?
See, if the government focuses on growth through capex, we don't think that's very inflationary. So it's not an either or in that sense. I do think that the revenue situation will allow for a step up in capex along with a moderate fiscal consolidation. So that's what we're hoping to see tomorrow.
Any sectors that you will be focusing on? I mean, infra is one of them that we have been seeing spending increasing every year. Yeah. In addition to that.
So all the infrastructures, other than that, we'll also be looking at urban housing, rural housing, for example, agriculture, what kind of outlays are there to support the rural sectors, the PM Kisan Yojana, etc. NREGA. These are obviously the two big ones that we look at for the rural sector. And the subsidies in general, and also any hint that may be there about, excise duty. If crude oil remains elevated, if the retail prices cross a certain threshold, is there any hint as to potential further reduction in the excise duties to be able to combat the inflationary impact of that? Of course, that opens up a fiscal bruise, but that's something that we will have to balance going forward.
I really missed out on a very important question. Unemployment, which is on a rise. Job creation is one of the things which everybody wants that budget should really address. So what do you have to say about that?
I'm going to sound like a broken record. Higher capex, spending, push to infrastructure, that creates jobs. So I certainly think that that's an important part of it. Outlays for the PLI sectors, we are seeing announcements for the PLI sectors as well as, in certain sectors, we're seeing that Make in India is starting to really take root. Announcements are there in terms of fresh capacity that are going to be added. And job creation comes along with that. So we're hopeful that we're going to see more of announcements along these lines.
Thank you, Aditi, for your time. It was a pleasure speaking with you as always. Thank you so much.
Thank you, Geetu. Thank you so much.